Welcome to this week's 5 and 20. Hey, Brad.
Hi, Casey. How are you this morning?
Doing good. We're doing our 5 and 20 from remote locations. So hopefully this technology works for us today. Let's just get right into it. I found some articles interesting this last week. Interesting theme. A couple of our articles really had me baited. And I read them. I was like, oh my gosh, is it really like this? And then towards the end of the article, it says, no, it's not like this at all. So that's a little cheat to this 5 and 20 is that maybe we're doing the same thing here. But there's an article in the Wall Street Journal talking about the tech boom and then bust in 99 and 2000. And it says there's some similarities between tech stocks now and tech stocks then, specifically the leaders. You look at Tesla's falling back a bit on price. We have some other leaders that have fallen a third to a half in value. But then also we have some tried and true winners that just keep going.
For investors who remember during the period of the dot-com bubble, as it's referred to, these were what we called high-flying internet tech stocks. The internet had just kind of come along. People were betting it would just be the greatest thing in the world, and come to realization, and it has, but it was just too early in the development period for these companies who went public to actually have a product offering that they could monetize at that time and create real revenues from. The Nasdaq surged to just over 5,000, in March of 2000. By October of 2002, it had fallen all the way down to 1,100. These tech stocks that dominated the Nasdaq, just took in a tremendous hit. Investors, lost, unfortunately, a lot of money due to the IPOs, especially that came out during that period, touting these technology opportunities that were going to come and eventually did come, but just weren't there at the time.
Yeah, the also is how the S&P reacted. I think the S&P, those stocks did decline a little more than the investor would like by the mid 2000 area. But really, right now, coming out of where we have been, you could argue that the S&P, while still priced relatively high, is priced relatively high because of a lot of the high flying stocks, and that there's a lot of stocks right now you could argue they're probably still good value over the long term. So I don't see the correlation at all, other than maybe for the few names.
Especially when you look at interest rates then versus interest rates today. So interest rates represent the alternative investment for investors. So back then, a U.S. 10-year Treasury was paying 6.5%. Today, it's paying 1.5%. So
right,
it's the alternative that people could go to back then versus today. So that's playing a big part of keeping this market moving forward and upwards.
So we shouldn't be scared. That's the bottom line.
Right.
The headline did not match the article in the end. There are some similarities, but really, I don't see any risk of that kind of a magnitude of a correction. Next topic. I hate reporting on this stuff, but an advisor was caught stealing profits. The firm, and this is an email that I get from a regulatory monitoring service that the SEC issued a report. And I thought I'd share this with our listeners. The firm is UCB and Financial Advisors down in Miami, Florida. I looked them up online. There's clearly some fishy stuff going on here. One is every year we have to file disclosures as a firm, and their disclosures are the same as they were in 2017, even to the date. So in 2017, they were only managing $4 million. I assume that it's obviously grown because of what they're doing. But basically, the concept was they're trading as a group. So we do that. We'll trade as a firm, But what the difference was, they were taking their trades, and these would probably be mostly individual securities, I would think. The profitable trades at the end of the day or during the day, they would move to their personal accounts, and then the negative trades, they would move to their clients' accounts.
Well,
And I'm sitting there going, what the heck? And they allege they've been doing it since 2015 to the tune of making millions of dollars churning and trading accounts by segregating all profitable accounts to their family members' accounts. It wasn't them personally, but you know that it had to involve them if it has their family associated with it.
well, I want to go along with what you said. It's troubling that we keep having to bring these types of topics up, that this industry is still dealing with some people some bad actors in this case. And they got away with it again simply because people are writing checks to them to be deposited into that house account where they would place their trades, and then they would transfer those trades to the appropriate individual accounts based upon profitability.
That
That's who
that's
got
something
the trade.
that's an angle I actually hadn't thought of. I thought that they were doing it in their batch trading account as a firm. So it
They were
could be
placing
that
it in a house account.
it could investors were writing checks to them personally, but they could have been writing checks to their broker dealer, and then under the broker dealer still self-dealing by moving those assets there. I mean, the report doesn't go into specifics of how it was happening, other than it was happening. And I think the key to that, I mean, how would you prevent that from happening? First of all, um, I'm a firm believer, if you're not Schwab, Fidelity, TD Ameritrade, maybe Pershing, I don't know that you should be with that firm. I mean, the firm is obviously too small to be on a larger platform like we're on, but inside these independent broker dealers, I know that there's good ones. I don't know them personally because we don't work in that world at all. But you got to be a reputable company that has some type of oversight. I just have a hard time imagining this happening at a big four, big five firm. At least happening for that
Kudos to
many
the
number of
individual
years.
investors who finally recognized that they were being on the short end of all these trades and began to peel back the layers of the onion, if you will, and found out exactly what was occurring. So congratulations to them. It's a shame that they had to go through this. It just goes to show how important it is that you need to review those brokerage account statements, everyone. You have to review those and scrutinize those tremendously
And
in
look at
order
your
to
rate of
make sure
return
that what
versus
you're getting
and
is what you're paying
yeah,
for.
and look at your rate of return versus the market. That's another good benchmark too. Is what is if you're in a moderate risk portfolio, you should have about half the risk of the S&P 500. Turn the TV on, or look it up online. If the S&P is up 10 this last year, you should be up around 5. I mean, that's a very crude benchmark, but in this case, they had to keep losing money for their clients, and the clients obviously were accepting it for whatever reason. And you have to be careful about who you're placing your trust in too. And again, it's this was a smaller firm in this case, but it happens at big firms too. We see it all the time at big firms. Not this specific error, but just lack of portfolio organization, really.
Well, it's something you just said. It's, be careful who you're putting your trust in. I mean, when we talk to clients, we recognize that although we take discretion on the account, we often counsel them that you're not abdicating your your investment management. You're outsourcing it to a professional firm that you've hired, then that you oversee every period that you receive your statement. You check your statement versus our statement, make sure that it matches. So
Right.
you're outsourcing this duty rather than abdicating the duty. So
Moving on to the next topic, digital assets continue to sell off. ETF.com had a good article on this. Basically, not all digital assets are selling off. It's really just Bitcoin, and it's selling off quite quite at a pretty good magnitude. So we're seeing withdrawals from a lot from the Bitcoin ETFs as well as the selling of the Bitcoin. The sad thing to me is that I'm seeing the same thing happen here that happens in any other asset class, whether it be Apple stock, Amazon, what have you, is when we reach a top, you know, mania sets in. McKenna Cooper, our college intern, she has a good blog post right here on this channel about tulip mania and what it was back in Holland. But there's a little mania around here. We hit what 60 something thousand in Bitcoin. Everyone's talking about it. I literally drove. I'm on a trip this week with my son. He's in a golf tournament, and I stopped at a gas station, and there was a digital sign that says "Buy Bitcoin here" at a gas station in the middle of nowhere, Georgia.
I took a trip last weekend. The limo driver that picked me up from the airport, it's all he wanted to talk about the entire ride out to my location was Bitcoin. The limo
That's
driver.
crazy.
Mm-hmm.
So that is a sign of mania. So we have people who probably bought, 50, 60,000, and then now it's dropped back down to around 30 or below 30 temporarily, and they've taken all these losses by liquidating. And that's it's kind of like our last episode. We talked about speculation versus investing. So there's a lot of speculators out there in digital currency. So you have to remember that there's going to be a lot of volatility. If you believe in the tool, if you believe in it long term, then you need to hold it long term. Don't be trading stuff in and out, in and out. I was actually on the phone with a client yesterday. He says, "Hey, I bought a pretty good amount of Bitcoin, but I doubled my money, and then I quickly was able to take my initial investment, right, and then I was able to now look at it as it's just all profits being invested." So if you're in a situation like that, maybe you take your principal out, but then you leave the rest running long term.
Well, and keep in mind it is speculative at this point. It's becoming more and more regulated as these exchanges come online, but it's a speculative investment.
There was a great article in ETF.com about just overall investing and how market analysis can have bias, which I found very interesting. I'm trying to pull the article up now here on my screen. It was basically covering. Stand by. I had it all ready to go.
Yeah, it's called reducing noise and bias in investing. And it talks a little bit about investor behavior and tries to define the difference between noise and bias. And noise is the difference between the forecasts of different forecasters. So you have all forecasters are all forecasting the same topic, but they come in with different recommendations or analysis. And the noise is the difference between this, the dispersion between the forecasts. Bias is the fact that certain forecasters, economists, investment managers, always are going to be high or always going to be low based upon their perception of the world and the circumstances. And so that's the difference between noise and bias is simply the range of forecasts versus those that tend to always be high or tend to be low. So it's and then it goes on and talks about, I thought was interesting, those of different personality styles. Indeed, those that are can get out and promote their story via media, television, news, etc., tend to be thought of more highly than those that may be a little more introspect and and not promote themselves as well. But their numbers may be more accurate. Who knows?
Well,
So
I thought that was very interesting. You have a person on CNBC who's very confident in how they're presenting their material, and this is how it's going to happen. And then be able to move the viewers. And you may have someone who's more reserved saying, well, this is what I think is going to happen in the markets, but there's these 5 things out here that I can't quite figure out, and it's probably going to change my analysis. Those people are viewed as weak, right? And so but yet they tend to be the most right. So the forecasters that are the most right are generally the ones that are always revising their forecasts, as opposed to someone saying, yep, there's going to be a recession this year for sure. The author of the article it's Alan Roth. Alan is with an hourly planning firm, I think out in Colorado, Wealth Logic. I'll give him a plug. I went and looked him up, and he has very interesting disclosures. Actually, some a little comical when I laughed out loud a few times when I was reading his disclosures. But he's an hourly financial planner, Brad. I mean, we do hourly financial planning as well, and it was very interesting that he said, despite the market's uh, uh, opinion that hourly planning never works for the advisor, he seemed to be doing pretty well. And I think we're in that same boat, that hourly financial planning does indeed work, despite many in our industry saying how terrible it is. But anyway, I loved his article. He's referencing Noise, the book Noise, A Flaw in Human Judgment, which is not all about investing. It's about just how we have biases in our decision making process. Daniel Kahneman, I believe, is also an author
He's
on
one of
that,
the
a
authors who
co-author.
also received a Nobel Prize in economics, I believe, back in 2002. And we did a podcast on this, and he talked about investor bias. Hubris was, I think, part of it. I think that's an interesting word. I've always wondered more about that.
Right.
And how
And
we make decisions and how we
and
live with those, and the ability to accept decisions that go well and those that not go well, and how it affects us in our future decision making as well. So it's interesting that they're almost sociologists who they move into economic realm, because so much of our decision making is in our financial lives.
it just so happens that we're about to do a podcast this week that will produce next week, about how to remove those biases and it's for ETFs. It should always be in everyone's portfolio. This is proof. I did not read this article, then come up with the podcast idea. I had the podcast idea, and then this article showed up later. So
You're ahead
I
of
was
your
like, okay,
time.
that was ahead of my time. Exactly. All right, so last bit, I was reading this article in the Wall Street Journal, talking about it's an opinion article, talking about all the government stimulus that is coming out, specifically about this child stimulus. You're going to get
The
a
child
monthly
tax
amount.
credit, that's acting as a stimulus, because they're paying it directly to families, parents that have children, and it's going kind of right on, piggybacking on top of the federal unemployment. This has nothing to do with them being employed or being unemployed. They're fronting, the child tax credit that we would normally get when we file our income taxes in April.
So one of his fears, and this is Robert Doar, D-O-A-R. He's a president of the American Enterprise Institute. He served as New York City's Commissioner of Social Services from 07 to 13. What I found interesting about the article, this is something I never really thought about, because you and I probably think in terms of economics, and we're going to stimulate the economy and get money to these families, and they can spend it on shoes for the kids or whatever, right? Vacation. It's probably not that much money, but something. And he had a good point. He said, we're about to put cash in a lot of people's hands, especially on the low income side, with no oversight. And what he saw in New York was that if they attached a social worker to payments, that actually the cases got a lot better, because you have drug abuse, you have spousal abuse, you have alcohol abuse, not in every low income family, but a lot of low income family that are struggling, that don't have a good family nucleus around them. And what I found interesting is that he's saying, hey, you're about to promote all these things and you have no oversight. One of the questions to get welfare in New York was, are you being abused as a spouse, right? Are you being abused as a spouse? So if that's removed, those questions are removed, we might be opening up a can of worms for some families and do them a lot of harm. It was just an
Well,
angle that I hadn't really thought about. not saying this is right, this is wrong, but I have to say I didn't think about that.
It's the law of unintended consequences, I think, that you're describing, Casey, in that, that for all the good that they think they're trying to do, there are going to be unintended consequences to some of this that's going to have a negative effect on different families. You talked about different abuses and substance abuse. There's financial abuse as well, not knowing how to handle. This is a windfall, at that level for some low income families, not understanding how to manage that money, saving some or putting some
Right.
aside for future unknown emergencies, and teaching them how to, manage money relative to their needs as a family and what needs to be purchased. You mentioned shoes, food, housing, utilities, school supplies, etc. So I can't believe that they're not attaching some kind of, social effort to go along with this financial effort at the same time. The government has just flooded our communities with money. It just has, and has had no oversight whatsoever.
If they did that, they'd have to go through the states, and that's part of the problem. Is the federal government
well, then you have
can't get all
50
this
different programs in 50 different places. Then you have
Right.
local programs and,
Right.
and so on. And then you have one caseworker for 700 people.
True.
That all of a sudden that prior didn't have a caseworker.
All right. Well, we're out of time to solve this one, but Brad, good talking to you.
Thanks, Casey.